The play for investors in the U.S. is probably to remain overweight in equities for the remainder of the year. We're going to find out why with Doug Peta. He is the Chief U.S. Strategist at BCA Research. Doug, welcome to the David Lynn Report. Pleasure hosting you today. Thank you for being here.
Thank you, David. Thanks for having me on.
I have to disclose, I worked with you actually at BCA. It was my first job. Very honored to have started my career at BCA. Great firm. You're a great strategist, so I learned a lot with you. So I'm very happy that we're able to catch up and talk about econ and macro. And now you can educate the audience with your knowledge, Doug. But I want to start with your overall view on the economy. You wrote in a note to me that you're mostly at a consensus in the sense that you don't think a recession is going to come anytime soon. In fact, you think it's going to come in the first half of 2024, which is a little bit out of consensus because most people I've talked to have told me that a recession may come a bit sooner than that. So walk us through your thesis for why it's going to come later than sooner.
Sure. Ultimately, I think that the consensus of investors is underestimating the strength of the American consumer. We believe within the U.S. investment strategy team that U.S. consumers have the wherewithal to continue to grow their consumption at a rate that will stave off a recession until sometime in 2024. It largely stems from the mountain of excess savings that households were able to build up during the pandemic. At its peak, we estimated that those savings amounted to $2.3 to $2.4 trillion. We estimate that households in the aggregate still have $1.3 trillion of those savings left. And we further estimate that right now, with the savings rate running at around 5%, that households are drawing down those excess savings at a rate of about $50 billion a month. Now, we certainly don't think this expansion is going to go on for another 2 years, but if you divide 1,300 billion by 50 billion, you get 26 months. Now, we don't think every dime of that money is going to be spent, but we think it is clear that households have the capacity to keep the expansion going for the rest of 2023. And to date, they have evinced a willingness to do so.
I was just reading an article from CNBC that came out earlier this week, last week, and they reported that the credit card debt in the U.S. hit an all-time high of $930 billion, according to data released from the New York Fed. We can interpret this a number of ways. Like, how would you interpret it? Are people spending because they're optimistic about the economy and perhaps they think interest rates are going to fall, which is why they're racking up debt? Or are they spending out of necessity because they know that their savings in their bank account are dwindling?
Broadly, there are three ways to fund consumption. A household can do it from its assets, which touches on savings. It can do it from its income, or it can augment either or both of them by borrowing. We are confident that households still have plenty of excess savings that they can draw upon. Income is robust. Now, it's had a hard time, wage growth has had a hard time keeping up with consumer prices, so that across most of 2021 and 2022, all of the major wage series, when adjusted for inflation, actually showed negative growth. But now that we've gotten into 2023, some of those series have actually overtaken consumer prices. So has been some real income growth in terms of hourly wages or annual salary. And more people are joining the workforce. We still have expanding payrolls. The non-farm payrolls number that we get the first Friday of every month keeps growing and is growing at a really healthy clip. The average is in the low to mid 200,000s now, the 3-month moving average. And the estimate for the amount of payroll expansion that's required to keep the unemployment rate at a steady state is somewhere between 70 and 80,000. So we've got expanding payrolls, even If real wage growth is zero, when you've got more people working, that means more household income coming in. So two of the three sources for supporting consumption, assets and income, are quite robust. That in the aggregate, then, households don't need to borrow. I would submit that the increasing credit card balances do not indicate that in the aggregate, American households are under distress. And I think it is important when looking at the credit card balances to compare where that level is relative to its trend growth rate before the pandemic. In nominal terms, so without adjusting the balances for inflation, credit card debt has only in the last several months gotten above that trend growth rate. And when I say trend growth rate, we have used within the U.S. investment strategy team the rate from 2011 through 2019, which I like to think of as post-crisis, pre-pandemic. Now, everyone agrees pre-pandemic ends December 31, 2019. We're also taking out 2009 and 2010 because there was still quite a bit of volatility coming out of the crisis. So in nominal terms, just barely broken above that level. In real terms, adjusted for inflation, we're not there yet. We're still not back to where we were December 31, 2019. So no, we're not concerned about rising credit card debt levels. Delinquencies have begun to normalize, but credit card delinquencies are still just shy of where they were February 2020 at the last month before the pandemic. And remember that February 2020 came at the end of the longest expansion on record in the United States. So that's a pretty tough comparison. And credit card borrowers are still beating that comparison.
I guess my next question is more philosophical. Just because consumers have the ability to spend, which is to say that they have the assets that you talked about, is there a propensity to spend right now? If everybody believes that a recession is coming at some point, either later this year or next year, the timing is up to discussion, but if everybody believes that there is going to be a slowdown, wouldn't people naturally want to save more now, and that becomes more or less a self-fulfilling prophecy?
It's definitely a threat to our consumption-driven thesis. But if we've learned anything over the last couple of years during the pandemic and even some of the years preceding the pandemic, when it comes to consumer sentiment surveys, I'd say watch what they do rather than what they say. I just read about a paper this week that found that perceptions of the economy among consumers is more tied to political affiliation than it has ever been. And I think we sort of knew that at BCA because Gallup breaks out if you're a Republican or a Democrat. And when there's a Republican president, Republicans feel much better about the economy. Democrats feel worse, and vice versa when a Democrat is in the White House. But what this paper did was it closed, I think it answered an important question, which is that does that perception of the economy based on one's partisan affiliation affect one's spending? And these researchers found it doesn't affect spending in any observable way. So, of course, this could be a self-fulfilling prophecy. We do have to watch very carefully, but that paper says you can disregard it if it's coming from partisanship, which certainly a large part of perceptions of the economy seem to be. And I think just the last year has been instructive. In 2022, the University of Michigan Consumer Sentiment Survey was moribund, 2 standard deviations below the mean. Whereas the other major survey, the Conference Board's Consumer Confidence Survey, spent most of 2022 about a standard deviation above its mean. That disparity between the two surveys is incredibly unusual. Typically, the two of them move in lockstep. I would say that what people did was more in line with the responses to the conference board survey than it was to the mildly optimistic conference board survey, as opposed to the flat out despondent University of Michigan survey. If you dig a little deeper, the difference between the two surveys, aside the fact that the University of Michigan one is vastly larger, is that Michigan really homes in on inflation, whereas the conference board is mostly aimed at the job market. And as we know, the job market was very, very robust in 2022, remains robust now. So that if University of Michigan respondents were feeling uneasy because they saw gasoline prices rising, and every time you drive in your car in most of America, you're going to see 3 or 4 gas stations with posted prices per gallon, that seemed to have brought down sentiment as measured by the University of Michigan survey, but that didn't show up in consumption. And so, again, you're right, it's absolutely a threat. It's something we've got to watch. But to this point, it has not shown up in consumers' actions.
Well, let's talk about this regional banking crisis that we saw over the last couple of months. Some people have argued that the consolidation of banks is in itself likened to quantitative tightening, in the sense that we have less liquidity now available in terms of loans available to small businesses. Do you buy this argument?
It's also something that we have to watch, but to this point, we haven't seen any evidence of a reduction of credit availability. In the 8 weeks since, for which we have data, and I say qualify that for which we have data, because the Fed publishes a balance sheet for the entire banking system every Friday through the Wednesday before. So it's a 9-day lag. So in the 8 weeks for which we have data since Silicon Valley Bank failed, overall loans and leases held by U.S. banks has risen by 20 basis points. It's not a ton, but it hasn't fallen. And that modest increase in loans has occurred alongside a 2.6% decrease in deposits. So deposits did flow out of the banking system to the tune of 1% a week in the 2 weeks after Silicon Valley Bank folded. But since then, the deposit outflows have slowed to a trickle, about 0.1 of a percentage point per week. That does not appear to be a rate of outflows that is stressing the banks, limiting their availability, limiting the availability of credit and the bank's ability to act as a financial intermediary, providing credit to, as you mentioned, small businesses. So again, something we've got to watch. By no means should anyone think this story is over. But to this point, again, what they do doesn't evoke a whole lot of concern, even though what they're saying does suggest that we should be on our guard.
I want to touch on real estate now, both commercial and residential. Let's focus on the commercial side first. You have a slide showing exposure to real estate from the commercial banks, the regional banks. There's been concern from some investors about commercial real estate. Charlie Munger, Elon Musk have both voiced concerns about the sector. How concerned are you that commercial real estate is now threatened because of the collapse of certain regional banks?
Certainly, it is something that we have to watch. And it's the third time I've said that now. For markets, though, so I'm saying that, look, we do have to be vigilant. However, in every case, I think markets have priced in a pretty negative scenario.
Okay.
And that if the base case that I'm suggesting, which in each case is more benign than I believe has been priced in, given the media attention, given how much our clientele at BCA wants to discuss these issues and wants to discuss these issues from a position of being pretty concerned, I think there is scope for all of them to surprise positively. When it comes to commercial real estate, we have to remember that not every niche within commercial real estate is threatened. I would submit that anyone who has lent for a multifamily residential project, an apartment building in the last few years, is going to be repaid in full and on time. We do not have enough residential units in the United States. We have not constructed enough units to keep pace with household formation for several years. As a result, I believe in general, for dwelling places in the United States, demand exceeds supply. That means you're in a pretty darn good place if you are a supplier of this commodity that is in short supply. And if you are a lender to those suppliers, you're going to come out pretty well on these loans. I would further submit that anyone who has lent to any sort of warehouse project that is required within the ecosystem of delivering retail goods that are purchased on the internet to homes is in a really good place. That was about the hottest thing in investment in 2020. And it certainly was the hottest thing in commercial real estate. The fleet of UPS trucks and Amazon vehicles, they get serviced by these buildings. So warehouses, completely fine. Apartments, completely fine. A lot of industrial buildings, completely fine, as we look to at least some measure of onshoring following the disruptions and supply chain snafus that manufacturers experienced during the pandemic and a couple of years afterwards. They should all face pretty good demand. Offices are about 1/6 of all commercial real estate. So no doubt in central business districts of some of the larger cities on the coast, there is no doubt the value of office buildings has declined. And surely some of those buildings, the borrower is going to mail the keys back to the lender. We've already seen headlines of that occurring. Surely there's going to be more of it. Additionally, street level retail in those central business districts is also pressured. I had a meeting in Seattle about a month and a half ago with clients. There was one person from the client on site in the room with us. There were 53 people watching from home. And I said, 4 years ago in April of 2019, on this particular day, there were 54 people looking to get lunch here. Now there's one. Right? So 2% of the lunch demand that there was 4 years ago. That's going to be tough for street level retail in these central business districts.
Right.
But all told, even when you wrap that up with these office buildings, it's certainly not a preponderance of commercial real estate. It's a real small minority.
Just before we move on. Sorry, go on.
Surely some lenders are going to go down from this. Surely there are going to be some smaller banks in the United States with loan portfolios that are concentrated in mortgages to office buildings and or the retail around them. But I don't think that's something where you're going to notice at the aggregate level of the economy in the United States. So just to tie a bow around it, that slide is titled WFH does not equal GFC. Work from home does not equal the global financial crisis, because that pie chart shows the largest 25 banks in the United States only hold 20% of those commercial mortgage loans. And really, there are only 4 banks in America that can create a systemic problem: JP Morgan Chase, Bank of America, Citi, and Wells Fargo. There are only 4 of those 25. So those 4 systemically important commercial banks, their share of this exposure is minimal. and
But just
doesn't matter.
hypothetically, Doug, hypothetically, if CRE were to crash by the order of 50%, the other 80% of that pie chart, banks with less than $250 billion, they would see significant write-downs, right? But that's not a systemic issue, you're saying?
I don't think so. Again, I think the systemic issues are concentrated in four banks. And remember that even if values crater by 50%, David, the typical loan to value for a new commercial loan is 70%. So you would have the collateral go from 70 cents to 50 cents. But if it were a loan made today, the loans they amortize over time. So when the banks have been reporting their quarterly earnings and trying to assuage investors' fears, they're saying, look, our average LTV on the portfolio, loan to value, is somewhere in the 50 cents or in the very low 60s. So even if we were to have, this cratering down to 50 cents, well, for the banks, it may only be 57, 58 cents to 50 on a modest portion of their overall commercial mortgage portfolio.
Well, let's move on and talk about monetary policy now. Interesting situation that the Federal Reserve is in. The Fed staff's projection says that they expect a mild recession by the end of the year. Jerome Powell, Fed chairman, at his last press conference, has said that that is not his own view or the view of all the other governors, which is to say that he doesn't think that they're going to get a slowdown by the end of the year. In fact, he says that in his words that he thinks that growth will remain. Is he signaling more rate hikes with that message, Doug?
I don't think so. I think he has been at pains to communicate the message to investors and overall actors in the economy that the Fed is data dependent. Nothing has been decided in advance, and that whichever way the data point, the Fed will follow. But I think he has given the message, and the way the wording of the statement has changed, that if the Fed's base case, if the FOMC, Federal Open Market Committee's base case comes to pass, then it is very likely done hiking rates. A key element of that base case is that inflation is going to continue to decelerate. Now, he says, might not happen smoothly, but the FOMC is of a mind that, as he said a couple meetings ago, the disinflationary cycle has begun. And our view of BCA is that that is a correct reading, that we will see inflation decelerating across the rest of this year. My personal best guess for the end of the year is that we'll get to somewhere between 3 and 3.5% year over year. Now, that's not down to the 2% target. That doesn't mean the inflation genie is fully back in the bottle, but it's a whole heck of a lot better than 7 something, 8 something, even 9 something percent. So things are clearly moving in the right direction. And we do expect that that movement in the right direction will give the Fed justification for not hiking any further, especially if the labor market continues to ease. We've still got quite high payroll expansion month over month for an expansion that looks like it's nearing its finish, but that's coming from a high level, the easing that we're seeing. So, yeah, we think that there will be enough easing in the labor market and that inflation will decelerate enough that the Fed can stop, that this 5 to 5.25% Fed funds target range that it has right now will continue to be the Fed funds target range for the rest of the year.
So will they cut next year, you think?
That is our view. And yes, embedded in that statement, I think, is a surprise relative to what the money markets are discounting, because the money markets are discounting 2-3 hikes before the end, 2 or 3 rate cuts before the end of the year. We think the money markets are going to be disappointed on that count. because, I'm telling you a story that the economy is pretty strong, stronger than people perceive. Well, that's not a backdrop that, to my mind, merits cutting interest rates, especially when we've still got quite elevated inflation.
Going back to your recession outlook and tying it back into investments, investors might ask you, Doug, does it matter if or when we're getting a recession? Meaning, is there a definitive relationship between the S&P 500 and economic growth? So just because we're going to get a recession, does that necessarily imply we're going to get a bear market for sure?
Definitely not. That's an astute question that someone who perhaps worked at BCA might ask. The economy, we do say all the time internally at BCA, and sure you'll remember this over and over. It's like a mantra or a refrain. The stock market is not the economy. But a thread that binds the two of them together is corporate earnings. It's S&P 500 earnings. To me, it does matter in the near term for making investment decisions as to whether or not the recession arrives before investors expect, when investors expect, or after investors expect. Given forecasts for economic growth, if you go to Bloomberg and the ECFC screen, economic forecasts, that provides the consensus expectations of a lot of economists. It's 50 or 60 economists. For the second quarter, the one we're in right now, that we're halfway through, the expectation is that US GDP is going to grow at 0.1% in inflation-adjusted terms. This is quarter over quarter and then annualized and seasonally adjusted. For the third quarter, the number is minus 90 basis points or minus 0.9 percentage point. And for the fourth quarter, the expectation is minus 0.3 percentage point. That is the very definition of a recession. So that to me says consensus believes the recession has either already begun or it starts right now. That recession expectation has the consensus of economists looking for microscopic growth in calendar 2023, somewhere between 0 and 0.5% real. I'm suggesting that the US economy can grow 1.25%, 1.5% real in 2023. That's really tepid growth. Right? That is short of the 2% trend growth rate that has been in place for a while. But 1.25 to 1.5 versus 0 to 0.5 is a pretty big gap. And if my base case is correct, and that expectations gap closes, I would expect along with the pickup in economic growth will come a pickup, or in economic growth expectations, will come a pickup in S&P 500 earnings expectations. And that tying this change in the economic expectations and the corporate earnings expectations, the S&P 500 earnings per share expectations, together with markets, the final piece is that I believe the marginal price setter in public securities markets is the professional asset manager who is judged on his or her relative quarterly performance, so that any asset allocator or multi-asset manager who has preemptively gotten underweight equities is going to be feeling some performance pressure to hold on to the assets his or her firm manages, or to hold on to his or her job to get back and catch up. Additionally, equity managers, I would expect, who have gotten preemptively defensive, are going to have to rotate out of the most defensive sectors, consumer staples, utilities, and healthcare, and back into the most cyclically exposed sectors, energy, industrials, and materials. And that is that's the basis for the market view that within our group at BCA, the U.S. Investment Strategy Group, that we are recommending with a 3-month time horizon, so a tactical time horizon, that multi-asset investors overweight equities and underweight fixed income. Now, We think the S&P 500 can get to 4,500 at some point this summer. We are overweight equities and underweight fixed income in preparation for that. The instant we get to 4,500, if it does, we will cut equities from overweight to equal weight and raise fixed income from underweight to equal weight, and we'll be chomping at the bit for the best opportunity to go underweight equities and overweight fixed income with a maximal overweight in treasuries and with as above benchmark duration exposure as any individual manager can stand, in hopes of riding or in preparation for riding the 10-year yield down from around 4% to 2.25%, 2.5%. Catching that move, from our view, is going to be the key to generating outperformance over the next year or two for any asset allocator.
We saw in 2022 both equities and treasuries decline. Basically, people have commented that the age of the 60-40 portfolio is over. But I suppose you're advocating for a return to such an allocation. I mean, I'm just throwing out 60-40 as a number. It could be anything, 70-30. But you are advocating for both allocations to fixed income and equities by the end of the year?
Well, no. So, when we want to at least in relative terms, no, we're not arguing for a relative overweight in both. The overweight in fixed income will be funded by an underweight in equities, just as our current equity overweight has been funded by a fixed income underweight. So, look, we think a recession is inevitable, although we think it's going to occur later than the consensus expects. So really, these predictions for 0.1% growth, 0.9% contraction, 0.3% contraction, we think that's a perfectly reasonable expectation. We just want to move that from the second quarter of 2023 through the fourth quarter of 2023 to, say, the first quarter of 24 through the third quarter of 24, the second quarter of 24 through the fourth quarter of 24. And if that sort of economic growth backdrop unfolds with a concomitant contraction in S&P 500 earnings that's at least double digits year over year, you'll really benefit from being overweight treasuries and benefit from being underweight equities. So our overweight equity call is only for 3 months or 4,500 points, whichever comes first. We just think that there is one more leg up for equities as that expectations gap between 0% and 1.25% to 1.5%, as that closes. We expect equity prices will rise as economic surprises keep occurring, such that investors raise that expectations bar. And I'd even bet you at some point this summer, if that all unfolds as we expect, that you're going to start seeing headlines reading, the Fed did it. We're going to have a soft landing. Never seen it happen before, but the Fed was able to tighten rates just right, such that it got that inflation genie back in the bottle, but the expansion's still going strong. We think the probability of that is really, really, really small, but we think people may well get fooled into that. And that is going to be the exact moment where you want to run as fast as you can from equities, because then there's no probability of continued positive surprises. And that's when you want to position for interest rates to be falling at the long end.
Well, we'll get an update from you and your team later in the summer once your stance pivots, Doug. But final question, and I'll let you go. This has been a great talk. I can talk to you all day, but we're running out of time. We've talked about the timing of a recession, but we haven't touched on the severity of this coming recession. In your view, what's going to happen to, let's say, the unemployment rate?
Say up a percentage point. So here we are around 3.5%. Maybe we get to 4.5% in the mild recession that we expect. If it is, a run-of-the-mill recession, or even a little worse than the run-of-the-mill recession, maybe we get to 5%. But For now, we do expect something mild. A banking crisis could certainly turn it into something that's worse than the run-of-the-mill recession, although we think that's unlikely. A breakout in inflation expectations, also something that we think is unlikely, but possible. If we would have a breakout in inflation expectations, then the Fed can't stop at 5 to 5.25%. Maybe it would have to hike another 2 or 3 times, getting the target range to 5.5, 5.75, or even 5.75, 6. If that were to occur, beginning sometime late in 2023, then we would expect a worse recession than average. And then let's say you get the unemployment rate north of 5%.
I do have one final point before I close off. I wanted to get your opinion on this. I've been hearing this a lot, especially last year as interest rates were rising. The Fed funds rate was rising. People have commented on the amount of debt that the U.S. government has. I believe it surpassed $30 trillion in November. And people commented on the fact that at current interest rate levels, the Treasury will be in a difficult position. Somebody even told me they would be unable to afford the interest expenses on $30 trillion of debt. Has that been evidenced at all by any data that you've observed that the Treasury is squeezed right now because of how much debt they have?
I think that is too dire an expectation that the U.S. would find itself unable to service the debt. But, in a broader sense, budget deficit, the big budget deficits can only be funded by more Treasury issuance. And the more Treasury issuance that is out there, the more the economy will suffer a drag as interest rates rise, because more of the United States budget, federal budget, would then have to be devoted to debt service. If more of the budget is devoted to debt service, there's less available for transfer payments, there's less available for disaster relief, there's less available for the defense budget. And I would argue that the defense budget has been very important for global investors, because the fact that the U.S. Navy is the unquestioned master of the world's seas has been really good for global capital. And that if service on the debt would force some reduced funding for that protector of global shipping, then global returns to investment ought to be expected to fall. So, the more money that has to be diverted away from stuff that helps growth to this albatross of debt, that weighs on the economy. And that is most certainly a drag at the margin, and could be something that would bring the trend rate of potential growth in the United States lower.
Mm-hmm. Okay. And where can we learn more about your work and BCA's work?
Look, we have bcaresearch.com, and we are real active in social media. Perhaps going to BCA's page on LinkedIn may be the easiest way for someone who is interested in getting exposure to BCA, trying out our work to see what it is that we're producing. But either via the website or via LinkedIn or other social media, we'll always take more customers. So we are come one, come all.
I haven't seen any posts about the debt ceiling, just so we close off here. Is that not, I suppose that's not really a concern for professional investors, that they will not raise the debt ceiling and the U.S. defaults on its debt. That black swan, is that likely to happen? Is that even on your radar?
Oh, it's most certainly on our radar, and it's very much on our in-house geopolitical strategist radar. Yeah, I don't know exactly what the probability definition of a black swan is, but they're saying it's 10 to 20% that the U.S. could default, at least temporarily. And that would open a Pandora's box of troubles. So no, it's very much on our radar screen. And I from my perspective, 10 to 20% is, well within the realm of probability, and not really a black swan event. It most certainly could happen.
Certainly the credit default swaps have risen in anticipation of this probability. But anyway, we'll see what happens. Thank you again, Doug, for coming on the show. Appreciate your time.
Thanks a lot, David.
And thank you for watching. Don't forget to subscribe.